Do you know how to lower your taxable income? Well, if not, we're going to give you some tips on how to do this today, so stay locked in. Hi, my name is Carson Graves, certified financial planner and president and CEO of the Retirement Education Center. And I want to welcome you once again to our Tuesday tips, where today we are going to be talking about a topic that is probably on everyone's mind who has any earned income, and that is taxes. Now, no matter if you are self-employed, if you're a freelancer, W-2 employee, or if you're retired, you're always looking for ways to minimize your tax burden. So today I am going to provide you with some simple tips that we give our clients in order to help them maximize their retirement income. So let's go ahead and jump into our lesson today. So the first thing that we want to do is understand what exactly is taxable income. Taxable income is the amount of your income that is subject to taxes after your deductions and exemptions. The lower this number is, the less that you're going to owe in taxes, plain and simple. So the first tip that I want to give you to help lower your taxable income is to maximize your retirement contributions. This can be done simply by contributing to your retirement accounts, like your 401k or IRA. The contributions to these accounts are normally tax deductible, meaning that they reduce your overall taxable income dollar for dollar. For example, let's just say you have annual income of $100,000 per year and you contributed $20,000 to your 401k. The amount of taxable income at that particular point for you will only be $80,000. By simply contributing to that 401k, you would have shaved $20,000 off of your taxable income. Now, the second tip that I want to give you to lower your taxable income is to consider timing your income and expenses. Now, if you are self-employed, this may mean that you will delay your invoices to the next year, or you may end up accelerating your deductible expenses for the year. Now, if you are a W-2 employee, you can still time your income as well. You can take maybe 1/2 of the income from your retirement account of what you're needing for a certain expense at the end of the year, and then at the top of the year, you can take the other half to make that purchase. For example, if you were looking to buy a car and it was going to cost you $30,000, well, you may be inclined to take that $30,000 and go ahead and buy that car with cash from maybe your retirement account. Or you can make a smarter move by taking $15,000 in December out of that retirement account and taking the other $15,000 in January and therefore purchasing that car in the following year. But by doing that particular strategy, you would have cut your tax burden in half. Now, the third tip that I want to leave you here today to lower your taxable income is to attempt to invest in tax efficient investments. Now, on this channel, of course, we do not give investment advice because we don't know you. We have to speak to you personally, but these are just some general ideas that you may want to consider. You may want to consider assets like municipal bonds, because the interest from municipal bonds can be federal and state income tax free. The next thing that you might want to consider are Roth IRAs, because Roth IRAs distributions grow tax free, and all of the distributions from a Roth IRA comes out tax free as well. So if you're trying to get more tax efficient on the back end of your retirement, you have to consider having a considerable amount of your resources in a Roth IRA. Another option that many people sometimes overlook is having a life insurance policy in which you can borrow the money from. By borrowing money from a life insurance policy cash value, that money will come to you tax-free. So it's not a taxable event. And you don't even have to pay that money back into the policy. If you pass away, your family will still get that tax-free death benefit minus the money that you've taken out of it through the policy loan. And the last thing that you're going to want to consider when it comes to investing in tax-efficient investments is making sure that you take advantage of long-term capital gains. When you take advantage of long-term capital gains, you're going to have a more tax advantageous situation on that income, because long-term capital gains can be taxed depending on your income anywhere from 0% to only as high as 20%. And when you're considering ordinary income taxes that may come from like your IRAs or short-term capital gains, those distributions could be taxed at your highest effective tax rate. So the moral of this video is very simple. By leveraging these tips that we've given you today, you can effectively lower your taxable income and keep more of your hard-earned money in your pockets. Please note that these videos are created for educational purposes only, and that you should always seek out your own financial advisor, your own tax advisor, and your own attorney regarding your personal situation. Also, if you are looking for an independent fiduciary advisor to help you with these types of complex financial matters, we highly recommend that you utilize the links in our description below and go ahead and schedule a 1-hour free consultation with us today. And we will also like to hear from you. Let us know what your thoughts are regarding this particular subject matter and leave any questions or comments in the section below. And if you found this information to be beneficial, all that we ask is that you subscribe to this channel so it can continue to grow, like this video, and share it with others.